We look at a number of indicators to try to gauge where the economy is headed. In June, we had a lot more positive indicators than we have now. In addition to that, a few other things have cropped up that have become important. Starting with the list, the number one thing that's been with us since last June, hasn't gotten any better, of course, is Europe. And it's not just the European debt crisis any longer that's sitting out there hanging over our heads. Europe is now in a full-fledged recession. There's no question about it. More than half the Eurozone countries are in their second quarter of recession. Those that aren't in their second quarter will probably achieve that at the end of next quarter. And so Europe is in recession. Europe's our largest trading partner. There doesn't seem to be any quick fix for the European recession. This could last well into 2013. By itself, it's not enough to put our economy into recession, but chipping around the edges, it certainly is in a position to slow growth going into 2013. So that's one thing that's a problem. Second thing that's cropped up recently is we've seen consumers' confidence slide back again. The early part of the summer, it was going up. When we looked at this in June, consumer confidence was up to 70. It's not great. 90 is normal, but it was trending upward, and we felt like consumers were starting to get excited again. That's important because they make up 70% of the economy. If consumers aren't happy, the economy's not happy. But we've seen that in the last 2 months slide back down, so now it's sitting at 60. That's problematic. Again, by itself or even in conjunction with the euro problem, not enough to cause us to slide into recession ourselves. Recently, in the last 2 months, we've seen gas prices, which had been trending down, now trending back up. The problem there is that every time gas prices go up by 50 cents a gallon, it takes almost $40 billion out of American consumers' pockets. And most of that money is money that would have been spent elsewhere, is now not spent inside this economy because we import about 60% of our oil, so it leaves. Those three things have caused us to become less optimistic going forward into 2013. So we look at the third and fourth quarter of this year, we think they're going to be both below 2% growth, and we expect 2013 to also be below a 2% growth rate. To put that in, probably as low as 1.5%. To put that in perspective, a normal year before all of this stuff got going was somewhere in the 3.5% growth rate. Recovery year should be stronger than that. But now we're not even in that 3% range. We're at half of that going forward for this year, 2012, and also for next year, 2013. What happens January 1st if the Bush tax cuts are not extended? The bottom line here is this, that unless some action by Congress takes place between now and January 1st, extending in some form the Bush tax cuts, they will automatically expire. And that has a severe set of consequences because on top of the Bush tax cuts, there is also most certainly the expiration of the 2% Social Security tax holiday. So that 2% increase in our paychecks for the last 2 years that we've experienced, because we've been paying 4%, 4.65% versus what we will now be paying is 6%, a little over 6%. That 2% change is in fact going to take money out of people's pockets. There seems to be no sentiment to roll that or to continue that on. That seems to be dead, okay? So that's going to happen. That's $90 billion coming out of consumer pockets, okay? So that's a real concern. Now, just to put it in perspective, $90 billion is about 2/3% GDP. So just by itself, that's going to take a 2/3% hit on GDP, just that one event, okay? Now, you roll back into that, the possibility that Bush tax cuts won't be extended. That's $110 billion, okay? So that's not good. And then you throw on top of that about another $125 billion if the Bush tax cuts aren't extended as it relates to something called the AMT, which is the alternative minimum tax, which most people in this country are completely unaware of. It's all part of this Bush tax cut scheme. And so if, in fact, the Bush tax cuts aren't renewed, the AMT will come back into place. The indexing will be gone away. It exists now, but it's been indexed up so high that most of us don't feel it. Now, all of a sudden, after 7 years of Bush tax cuts, it's not only going to hit the people making just over 100,000, it's going to actually come down even lower than that, okay? So it's going to start hitting more people when the indexing goes off. So people who weren't accustomed to paying the AMT before it was indexed may now start to get caught. That's a big number too. That's about $125 billion. So you put those together and you're talking Social Security, AMT indexing, or patch is what it's referred to, and the Bush era tax cuts, and all of a sudden you're talking over $300 billion out of Americans' pockets. That's 2% of GDP. If we're forecasting 1.5% to 2%, and I pull 2% out of your pocket, there goes your GDP growth. And so that's why I say we're on the precipice, if you will, of a situation where it looks like we're going to have meager growth another year like 2012. Yeah. But there's this downside if Congress and the president don't do anything between now and January 1st automatically. And that doesn't even include what's going to happen with the sequestration and the reduction in spending that the government's going to undergo should nothing happen between now and January 1st. So it's kind of piling on top. And the bottom line is, if the Bush tax cuts are not passed in some form, it's likely that that modest growth that we expect, meager growth in 2013, will actually turn into the double dip that we're all afraid of. As far as the unemployment rate in North Carolina is concerned, when this all started, North Carolina's unemployment rate was about 2 or 3/10% lower than the U.S. So we were in the 4% range. They were right at 5.1. About a year into this, North Carolina rate exceeded the U.S. rate, and now we've been running at about 1.5 to 2 percentage points higher than the U.S. rate. Right now, our rate's 9.8%. The U.S. rate's at 8.1%, and we don't see that changing anytime soon. So we not only have a jobs creation problem, we also have an unemployment rate problem in the state. And in Charlotte's rate's even higher than the state rate. And that's really unheard of in the past. So these are very disconcerting situations. And as I've said in June, and I commented in June, this is something that troubles me on two different levels. One's the economy and the folks that are affected by this. But the second thing is that, Charlotte and North Carolina, Charlotte, have been known as economic engines for the past 3 decades, and all of a sudden we can't seem to create any jobs. In fact, North Carolina has been, for the last year or so, been amongst the top 5 states in unemployment. So our unemployment rate right now in July is the 5th highest state in the United States. So, it's not good at all. Nationally, we've gained back about 46% of the jobs we lost in the recession. In North Carolina, we've only gained back a little over 30% of the jobs. So, we're just not doing as well now as the nation. We lost 333,000 jobs. We've gained back 106,000 so far. That doesn't get the job done. The interesting thing about this is that, going forward, there's not really any, if you look at the job numbers for the next couple of years, we're still not going to get through that. We said when this all began back 4 years ago, we felt like this was going to be a 7-year. It's going to take 6 or 7 years. It now looks like it's 7 or 8 years at best to get those jobs back that we lost. That's kind of the best case scenario looking forward. The job growth just hasn't seemed to appear. So this is all very, very troubling news, and the prospect of a weak economy next year doesn't help any of this going forward.